This week was a huge wake-up call for investors and their portfolios. Just in the last few days, we've had tariffs take effect in Canada, Mexico, and China, and the stock market has reacted with a lot of volatility. And if you're watching this video, odds are you're an investor who's looking to separate the signal from the noise and make the best long-term decision for your portfolio given everything that's going on right now. If so, you're in the right place because in this video, I'm going to give you an overview of the current tariff situation, what worries me more than tariffs, and what we can do to prepare. My name is Brian Dean. I'm a former investment banker with a Master of Science in Finance, and my goal is to help you master the market. So let's start by talking about the current tariff situation, and I want to begin by clearing the air on what tariffs are and what they are not. Tariffs, as you already may know, are a tax on imports. When a US company brings a product in from another country, they will pay an extra tax to bring that product into the United States. However, I often see headlines and other influencers saying that tariffs are therefore inflationary, and this is what I want to push back against. Because while yes, tariffs will increase the cost for US businesses, which may or may not pass those on to consumers, they are often a one-time increase in costs. For example, let's say you have an automobile that's being imported from Canada to the United States, and the original cost of that car is $50,000. Now let's say that as of right now, the United States is going to charge a 10% tariff on that car. So the cost in the US is going to increase from $50,000 to $55,000. But let's look at how this is going to show up from an inflation perspective. Before the tariffs went into effect, the car was $50,000. Now it's $55,000. So in the year that it went into effect, we would see a 10% inflationary increase on automobiles coming in from Canada. However, that tariff is not going to increase prices another 10% in the following year. So from year one to year two, the price would stay flat at $55,000 and you would see 0% inflation on this same product going forward. Now, I just want to be super clear that that is not an endorsement for or against our current international trade policy going on right now, but I just wanted to give you that information so that you know that when someone else says that tariffs are always inflationary, that that's not always the case. And as you'll see later in the video, I actually think that the current tariff situation going on right now is a bit of a distraction. In the meantime, I want to give you a brief overview of what's going on with the current tariff situation because I think it's still important that you know about it. So let's dive into some articles, starting with this one from the Wall Street Journal. This was from earlier this week. And we can see here that we have 25% tariffs on all goods from Mexico and Canada. And you can see already that Canada and other countries have started to respond with tariffs of their own. And honestly, that is all you really need to know when it comes to tariffs. So to summarize, we have 25% on Canada and Mexico, another 10% on China. There are more tariffs on the way, but there are two main reasons why I don't think we as investors should be focused on tariffs, and that there's actually something that I'm more worried about aside from this. The first reason is that this current administration is, at least in my opinion, very unpredictable, especially when it comes to implementing these tariffs. For example, they've already been rolled back the first time that they were going to take effect about a month ago. This month they did take effect, but now they've already been partially rolled back. They may be rolled back even further. And what this results in is a period of extended uncertainty, and I don't think we should be making decisions in our portfolios based on policies that may or may not be in place 15 or even 30 days from now. So that's one reason why I'm at least not worried as tariffs, but I want to get into the second topic of this video and the second reason why I'm not as worried about tariffs, because there is something that I'm even more worried about. And to tell you about this, I'm going to take you into another Wall Street Journal article, this time from an author named Nick Timiraos. And if you have a Wall Street Journal subscription, if you don't, I highly recommend one. And if you do, I highly recommend that you follow this journalist because his content I find is always spot on. And in this article, Nick has identified that there is a new risk to the economy, and that is stagflation. For anyone who doesn't know, stagflation is an extended period of high interest rates, moderate to low growth, and high unemployment. And the basis for some of these fears in the article include tariffs on imports that do threaten to increase prices, at least in the short term. And in addition to that, Nick has identified that there are various sentiment indicators and business commentary in recent weeks that point to slumping confidence over the threat of higher prices. And the reason that this is a big deal is that number one, we haven't had a stagflationary period in many decades. The last one that we had was in the 1970s, and it took about a decade to get out of that slump. And you can see here in the article that Nick quotes the president of the St. Louis Fed as saying, quote, a deterioration of the labor market alongside higher inflation, which is stagflation, could present difficult choices, which to me signals that even the Federal Reserve wouldn't really know what to do in this situation. And the same was true back in the 1970s. Now, many folks watching this video were not even around to experience this period in the 1970s. I know I certainly wasn't. If you were, I would love to hear about your experience in the comments because I think it would be very valuable to everyone else watching. But in the meantime, I want to show you this article from Investopedia, and it's a write-up of stagflation in the 1970s. And as we go through this article, we are going to look at some of the highlights here, and I want to see if you can identify any similarities to any other time that you have experienced in your life. So let's make our way through this article, starting with this sentence here that the 1970s saw growing federal budget deficits. Now, this may sound familiar to you, but I just want to put a chart to the number. This is a chart showing the federal deficit from treasury.gov. And as you can see here, it is definitely on the rise. We did have a spike here during COVID, but as you can see, that trend has not slowed down at all. So going back to the Investopedia article, the next point that I want to point out to you is that meanwhile, unemployment had exceeded standards set in 2 prior decades and growth was uneven. So next, I want to show you unemployment. This is from the Federal Reserve database. And as you can see, unemployment is on the rise. The second piece of that sentence is that growth was uneven, and I'm going to show you our latest quarterly real GDP, and you can see that it was uneven, but it was mostly positive. However, this is all trailing data. As you can see, this is from Q4 of 2024. There is an unofficial estimate from the Federal Reserve Bank of Atlanta called GDP Now. And this measure is a little bit more concerning. You can see that our forecasts were at around 2%, which would be fairly in line with these recent quarters. However, given the latest data, this estimate has now plummeted first to about 1.5 or 1.6%, and now it is all the way down to 2.8%. But unfortunately, the similarities don't stop there because as the article goes on to say that these set the stage of oil price shocks that would curb growth while fueling inflation. And while we currently don't have any oil price shocks going on today, in at least my mental model, I am substituting in tariffs and trade wars for oil price shocks in this example. There is a key difference here because as I said earlier in the video, tariffs are a one-time rise in costs and therefore aren't inherently inflationary. However, if we look down at the article here at this chart of crude oil price, you can see that there were multiple one-time shocks to the system in terms of the cost of oil, which increased prices and slowed down consumer spending. And the reason that I'm pointing this out, the reason that I'm concerned is because this chart looks to me like you could substitute one big set of tariffs here as the first shock. And if we get a second round of tariffs, which it kind of seems like we're headed in that direction, but again, I don't want to speculate too much, that could be a second shock, such as the one we saw here in this chart. Now, if you've stuck with me through the analysis in this article, I hope I haven't scared you too much because I want to answer the question of, do I think we are about to enter a stagflationary environment or not? And regardless of if we do, what can we do in our portfolios to prepare for that situation or even kind of somewhere in between where we don't enter quite a terrible stagflationary environment, but we do have some general stagnation for a longer period of time. And to really illustrate for you what that situation could look like, I'm going to take you back over to Thinkorswim, which is a really great charting platform that I like to use and have featured here on the channel before. And the reason that it's one of my favorites is that it has data going all the way back to 1929. So as you can see here, I've pulled up SPX, which is the S&P 500 index. I've set the time range to max. And if I scroll to the side here, you can see that this data goes all the way back actually to 1928. So next, let's go and find that period of stagflation, which was around 1970 to the early 1980s. So that's going to be about this period here. And if I go back to the stagflation article, you can see this was 1965 to 1985. So I want to show you that period there. And you can see that the stock market, again, this is the S&P 500, was generally flat and very volatile through that entire time. So we start in 1965 here. You can see that the index was at 90. Here it fell down to 75, which was about a 15% give or take decrease. Then we increased, then we decreased even more, then we increased even more than that, then we decreased even more. You can see that this big drop here was from 120 down to close to 60, almost a 50% drop in the S&P 500. And you can see that we remain at these levels all the way until about 1982. So if I draw my crosshairs at this level, at around the $107 level, you can see that there was a period from around the late 1960s all the way to the early 1980s, an over 10-year period where investors investing in the late 1960s would have had to sit through 0% returns with a lot of volatility for over 10 years. And the question that I think we need to be asking ourselves as investors is, are we prepared for such a period to happen again? And the answer may very well depend on you, your risk tolerance, your goals for your portfolio, your time horizon. But I want to give you 4 asset classes that I am looking into and putting into my own portfolio that I think will protect me whether or not the market goes up, down, or sideways for the next 5 to 10 years. And to show you these, I'm going to take you back to my computer screen here and over to a price chart, and I'm going to add these one at a time. So the first one is international stocks, specifically international stocks that exclude the United States, because I, of course, already have a lot of United States exposure in my portfolio. My favorite ETF for this is ACWX, and you'll see me add it to this chart here. And you can see that already year to date, that ETF is far outperforming the S&P 500. And the reason for this, at least in my view, is that with the threat of tariffs and the threat of an extended trade war, there are many countries that are resorting to removing US products from their shelves. As you can see on the screen, I've pulled up this subreddit, and this subreddit is called Buy From EU. This is a grassroots movement. As you can see, it was created in the middle of February in 2025. It has over 100,000 members, and there is a very vibrant community with post after post after post as to how to boycott US products in a big way and which companies are removing US products from their shelves entirely. So whether or not tariffs take into effect, there will be, at least in my opinion, a lasting impact for US products in other countries, including Canada, Mexico, various countries across the pond in Europe, as well as China. And while so far a lot of the tariff conversation has been focused on physical goods, as you saw earlier, there was a picture of whiskey as well as automobiles. This also extends to digital goods, and you can see here there's an entire chart showing which alternatives are available for EU citizens if they want to move off of US companies. As you can see, we have YouTube, Reddit, Netflix, and Disney. And there are already alternatives for each and every one. And the point I want to make here is that this will create a lot of opportunity in these other countries to create alternatives to these big US tech companies. This will in turn accelerate growth in some of these countries. And as you'll see in this post here, another user posted that the Germany stock market is already up 15% year to date. So these other countries may start to grow a lot faster than they otherwise would have as they become reliant on their own industries to create alternatives to big American products. The second asset that I want to share with you is gold, and the ETF that I use for my gold exposure is GLD. And again, as you can see, year to date, gold has quite outperformed, and it has had quite a stellar year so far. And the reason I like gold exposure is because it is a hedge against inflation. Its returns are also not as correlated to the S&P 500 as some other assets are, such as bonds, which means it will increase the risk return profile in your portfolio. The third asset class that I think will help prepare our portfolios no matter what comes over the next 5 to 10 years are utilities. And the ticker symbol that I like to use is XLU. This is the Spider Utilities Select Fund. And if we look at the performance year to date, you can see that the returns are a little bit closer to the S&P 500 because of course this is a bucket of stocks that's already in the index, so there is going to be some correlation. But the reason that I like utility companies is because they provide their services within the borders of the United States. Of course, there are going to be some utilities that have a little bit of foreign exposure, but by and large, these are not large industrial companies that have supply chains that span across the entire globe and need to rewire those supply chains in light of these new tariffs. In fact, over the last year, utilities have performed quite well with a 24% return compared to 15% for the S&P 500. And what you won't see on this chart that I'll pull up on here for you is that there is a dividend associated with XLU, and it's very healthy at 3.24%. The fourth and final asset that I want to share with you is real estate, and there are many REITs to choose from, but my favorite has always been GOOD. This is a real estate investment trust that I've talked about multiple times here on the channel. And as you can see, they've had very good performance over the last year, and year to date, they are about in line with the S&P 500. However, if I show you their dividend, which is not shown here on the chart and gets paid monthly, you can see that they have a 7.5% dividend yield. So I think with that yield included, they would have had a slightly better return than the S&P so far if this was in someone's portfolio. And the reason that I like this real estate investment trust, GOOD, is because their real estate portfolio is here in the United States. It's very high quality. They've paid out their dividend consistently, even through the 2008 financial crisis. And of course, real estate is a great investment hedge because landlords have a lot of control over their income by changing their rents in response to their costs. Moving right along, I hope this video was at least a little bit of signal amongst all the noise going on this week. I also hope you got some actionable value out of this video. And if you have any questions or follow-ups about anything I covered in the video, please feel free to let me know down in the comments below. I respond to every single one, and I will see you in the next video.